We all want our money to grow. We might save some and we might invest some. In doing so, we're participating in financial markets. In these markets, people buy and sell financial assets, such as stocks, bonds, exchange-traded funds or ETFs, and mutual funds. So how do you decide which assets to invest in? Let's look at their different characteristics. When you purchase a stock, you're buying a share or partial ownership of a company. Your slice of the ownership pie depends on how many stocks you buy and how many the company has issued. As one of many owners of the company, you share in its profits and its losses. When the company makes profits, the value of its stock can increase. As a shareholder, you can benefit in two ways. A company can distribute with dividends, a payout of cash based on how many shares you own. Or you can sell your stock for more than you paid for it. Your profit is called a capital gain. The result in both cases? You make money. Sometimes, however, a company's stock price may drop. In that case, you might wait and see if it goes back up. Or you may choose to sell shares for less than you paid for them and take a loss. Let's look at another type of financial asset. When you purchase a bond, you're actually lending money to a corporation or a government for a set period of time. The organization promises to pay you back the face value of the bond, plus some amount of interest which typically does not change. In other words, the interest rate is fixed. So you can hold the bond for 10 years and earn interest. Or, like stocks, you can also sell your bond in the market. However, the value of the bond can change. For example, over time, as nationwide market interest rates go down, your bond's value rises. Why? Because your bond has a higher interest rate than the market interest rate. It looks more appealing to investors, who bid up the price of your bond. Of course, as market interest rates go up, the value of your bond decreases. It no longer looks quite as good to investors as it once did. Other factors can change the price of your bond. If investors think that there is a chance the company may default on the bond, its price will decrease. Or, if inflation increases, then the price of the bond will fall because nationwide interest rates tend to increase when the cost of goods and services go up. So, which is a better investment, stocks or bonds? Historically, stocks have outperformed bonds over time, but have much more volatility or instability. Generally, stocks may have more potential profits, but higher associated risk. Bonds, particularly U.S. government bonds, may be a more secure investment, but with less potential return. It's important to understand that both stocks and bonds can lose value as well. So, how do investors lower the risk that they could lose money? They diversify. In other words, they buy a collection of different stocks and bonds. When an investor has only one stock, a sharp loss in the stock can be painful. But when an investor has a diverse portfolio of stocks and bonds, if any one investment decreases in value, the overall investment is much less affected. Is a diverse portfolio expensive or difficult to manage? It can be, but to make it easier, many people invest in mutual funds or exchange-traded funds. A mutual fund is an investment made up of multiple stocks and bonds, and sometimes actively managed by a professional fund manager. An exchange-traded fund trades like a stock, but it is designed to track an index, like the Dow Jones or S&P 500, or a commodity like gasoline or bonds. Both mutual funds and ETFs help investors diversify to reduce risks. Which investments someone makes depends largely on the amount of risk they are willing to accept. How comfortable are they not knowing how much they'll gain or lose from an investment? By understanding stocks, bonds, mutual funds, and ETFs, you can evaluate possible risks and rewards and make educated choices about which financial assets suit your needs.